Hey everybody, it is your Realtor Dave, and I have put together a list of the top 18 things you need to do as a first time home buyer from getting ready to purchase a house to closing and signing for your documents. So let's get into it. All right, the first thing that you need to do when you're getting ready to buy a house, and these are universal for anybody that wants to buy a house, you need to start saving. And what do you need to save? That's a great question. So let's talk about the down payment. So depending on what type of loan program you have, you're going to need a down payment. If you're doing USDA or VA, you don't need a down payment. If you're doing FHA or conventional, you're going to need anywhere between 3 and 5% depending on your lender for a down payment. So if you're buying a $400,000 house and you need a 5% down payment, you're at $20,000. If you're doing FHA, typically it's like 3.5%. So you got to have what, about $15,000. Okay. Closing costs. Closing costs range between 2 and 6%, depending on what state you're buying stuff into, what other things that you need, the title policies, things like that. And then you need about $3,000 or so for moving expenses. Now, that's just based off of a local move, doing it yourself, right? The U-Haul, the boxes, the paper, the bubble wrap, the dolly, uh, security deposits for your utilities, connection fees for this and that and whatever. So, if depending on what you want to do, you're going to need somewhere between $20,000 and $35,000, depending on the price of your house. Okay, now it sounds crazy and scary and big and bad and whatever, but there are programs out there that can help you out. A lot of times, new home construction, they're covering a lot of your closing costs to where you just need your down payment and moving expenses. You can negotiate that the sellers cover some of your closing costs. So you can have some help in it. So it's not very like, where am I going to come up with all this money? There are alternatives. Okay. You need to decide on your budget and then talk to a lender to see what that gets you. So if you're like, hey, we can afford $2,000 a month, you go talk to a lender and be like, look, I can afford $2,000 a month. What does that get me for a house? And they might be like, well, you can qualify for $175,000 if you're in the San Antonio area because your property taxes at $175,000 are just going to be an arm and a leg versus just an arm if you're in New Braunfels, for example, right? So and then your homeowner's insurance, depending on the house, is going to vary as well. Now, here's a tip on if you want to keep your homeowner's insurance lower, the newer the house, the better. The newer the roof, the better. The roof age is the main driving factor for the insurance payment that you're going to pay because the roof is the most likely thing that's going to get damaged in a storm and need to be replaced. Okay, then you want to go and check your credit score. When you check your credit score, you need to see where you're at. If there's some room for improvement, improve it before you go buy a house. Why? Because the higher your credit score, the lower your interest rate. The lower your credit score, the higher the interest rate, which means you're either going to pay or save money. Now, you want to choose your mortgage option. Are you going to go USDA? Are you going to go FHA? Or are you going to go conventional? Are you going to go VA? A lot of times you'll hear people say, well, you need 20% down to go conventional. No, you don't. You need to go about 3 to 5%. 5% is the most common one. And we're going to talk about here in a minute mortgage insurance. And that's 20% is the main number when it comes to mortgage insurance. Okay. You need to choose your mortgage term. Are you going to do 15 years? Are you going to do 30? Maybe you do 30, but you pay what it would be for 15 years so that, if you have life happens, you don't have a $3,000 mortgage, you have a $2,000 mortgage. Okay? You want to choose your loan type. Is it going to be fixed or are you going to get an ARM, an adjustable rate mortgage? An adjustable rate mortgage, you need to be cautious of, what are the interest rates here year 1, year 2, year 3, or however it works out. If you're doing a 3-year or 5-year, and figure out, make sure there's no balloon payment, but know that you are going to have a higher interest rate in 3, 4, 5 years, and be prepared for that. Research first-time homebuyer programs. There are first-time homebuyer programs out there that will help you with down payment assistance if you qualify. Now, here's a caveat. A lot of them will put a lien on your house. That lien will dissipate over, say, 5 years. So if they gave you $10,000, I'm just using random numbers, and they had a 5-year obligation to it, each year $2,000 is going to come off of it. So if you sold that house within 2 years, you still owe 3 years of that obligation back. So it's a debt that you owe. So you need to make sure that if you're doing a down payment assistance program, you understand if there's any early selling penalties. The reason they do that is so that people aren't like, here's $10,000. You go buy a house, a year later you sell it, and then you run away with that money. So they want to make sure that you're staying in that house for a while. Makes sense, right? You want to shop rates and fees. You can talk to 1,000 lenders. If you do it within 30 days, it counts as one hit towards your credit report. If you talk to a lender in January, 2 lenders in February, 3 lenders in March, you're now going to get 6 hits on your credit score towards your points. Okay, so you got to be careful. Talk to as many as you want. Do it within 30 days. See who's got the best rate with the lowest fees. Sometimes you may pay a little bit of a higher rate, but you have less fees. Sometimes you may have a lower rate, but higher fees. You gotta see. The other thing you gotta watch out for is a lot of lenders will come in and they'll show you a lower interest rate, but they're making you pay for it in what they call points in the back end for the closing costs. So your cost may be more higher and your rate lower. So you just gotta see if they're playing sleight of hand with the numbers. And to that, you got to figure out what the mortgage insurance is going to be. If you go with an FHA loan about 2017 or so, they changed the rules. It used to be just like conventional. So conventional, they have PMI, and with FHA, they have MIP, same letters, different meaning. It's just the same. It's just somebody had to feel special, so they moved some letters around to come up with something new. With conventional, when you have 20% or so equity in the house, you can petition to the mortgage lender to remove the mortgage insurance. Here's the funny thing. Lenders, they make you pay for insurance to protect them, right? I don't understand why they don't pay insurance to protect them. They make you pay for it. It's like kind of, you buying insurance for the bank for your auto loan. And, if you default, they get the money and you don't get the car. So with FHA, they changed it to MIP, and the mortgage insurance stays there for the life of the loan, which means that you're going to pay mortgage insurance forever until you sell the house, or you refinance the house into a conventional loan when you have 20% equity so you can get rid of it. So you may want to just look at, when you're talking to your lender, how much is that extra 1.5% going to cost to get you to the 5% for conventional? Can you get into a conventional for 3.5%? What are the rates? What are the fees? Because it may be better to stick with a conventional loan, pay a little extra, so you don't have to worry about refinancing and the cost for doing that later. Okay. So you want to gather your loan paperwork. I'm going to put a list of everything that most people need for a mortgage application. There's always somebody that's got a different kind of job, a different kind of income, but I'm going to give you the 99% solution. If you get all that paperwork together before you go talk to a lender, and then you're like, hey, here's all my paperwork, they're going to love you. You're going to become their next best client because you're making their job easier. So they might even work harder for you because you're already prepared and ready to go. Okay. And then if you're kind of for a sketch on some things, they may be like, well, these people are prepared and responsible. It shows a level of responsibility, and maybe they skirt some stuff for you. Okay. You want to get pre-approved or pre-qualified. Pre-approved, you fill out an app online. If everything's true, you would qualify for this. Okay? Pre-qualified is like you submitted everything and you qualify for that loan. Okay, so one's better than the other, but without even a pre-approval, most people aren't even going to accept a contract from you when it comes time to put an offer in on a house, because they're going to know that, one, you talk to a lender, two, you can qualify hopefully for that amount. Okay. Choose your real estate agent carefully. You want to vet them. Okay. You see me on YouTube. You can vet me through YouTube. Right? You can vet me through my Google reviews, 5 stars. But you want to talk to real estate agents. Talk to 2 or 3 of them. Figure out who you get along with. How long have they been in the industry? How much business have they done? I know people that have been real estate agents for like 60 years, and they do like one deal every 2 years. Okay, so maybe if they say, I've been in real estate for 60 years, it's not the best thing, right? I've known some people, like myself, for example, my first year in real estate, I sold like 15 houses. The most I've sold in a year, 55. But what I'm trying to get at is you want to deal with people who are actually involved in the industry, that are actually moving and grooving, and who have good reviews from clients. You want to narrow your home requirements, right? Do you need a 3 bedroom, a 4 bedroom, a 5 bedroom? Do you need a 2 bathroom, a 3 bathroom? Do you need a 2 car, a 3 car? Do you need to be in this community or that community or this school district? You need to figure all that out before you go looking at houses. I always tell my clients, pick 3 or 4 must-haves, and you can pick 5 or 6 would-likes. We're looking for houses that fit that must-have, and we try to find the one that's got as many of the would-likes as possible. But if you're telling me, hey, Dave, I want to look at a house that's $250,000, that's the 3 or 4 bedroom, it's got 2 bathrooms, and I need a 3 car garage. Those are my must-haves. And then you say, hey, Dave, I want to check out this house that's $375. It's a 2 bedroom, and it's got 2 car garage. I'm gonna be like, what's going on? Like, you got to figure out what your must-haves are, and everything can't be a must-have. 2, 3, 4 max must-haves, 4 or 5 max would-likes. If you can get more, the better, right? But if you have like 40 must-haves, you're never going to find your house. If you have 40 would-likes, you're never going to find your house. You need to be realistic about what you're looking for, okay? You need to stay within your budget, okay? That's the main thing, right? You don't want to go and start looking at houses when the lender's like, hey, 200,000 is like, where you need to be at to meet your budget. And then you're like, well, I don't like anything at $200,000. Let's start looking at $600,000. You got to make sure that, one, you can afford it, right? So you got to figure out that budget, and it's okay to change, right? Because sometimes you don't know what you don't know, and you want to own the house versus the house owning you, but you need to kind of figure it out. You can't be all over here and then all over here and over here and here and here and here and here. Figure out where your budget's at, and you want to stay within that budget. If we need to adjust that budget, too easy. We adjust it and we move. But you've got to talk to the lender when you're doing that, because you got to make sure your debt to income is right. You got to figure out what your payment's going to be to make sure that, one, you want to afford that, and two, you can afford that. Okay. Number 14, you need to have the home inspection. Okay, I just did a video on home inspections, so you can go check it out. It talks about the different kind of inspections, why you want to have an inspection, what they look for, what they don't look for, but you want to have an inspection. Home inspections, they cost anywhere from $450 to like $1,200. It just depends on A, the distance the inspector has to go. B, how big the house is. Every inspector bases it off of the square footage. 0 to this is this to that is this to that is this, right? Are you having them inspect the pool? Does it have an attic or a basement, and you want the basement inspected or a crawl space inspected? Is it on a septic? Is there a well? Is there sprinkler systems? So all these things like add up to it. So the highest inspection price I saw was about $2,800. Now, very unique property. They wanted an inspector that I knew, liked, and trust, so I recommended it. And the house was like 3 hours away, so there was a trip fee. And then it was a house, and then like a casita, and a pool, and a well, and a septic, and a big, huge, like grand entertaining area. And it's just a bunch of different things that were going on with it, and it cost them almost $3,000 to have that done. Then you're going to have to work on negotiating the price and repairs with your real estate agent, with the seller. Okay. Hey, you know what? These 40 things need to be fixed, but we only want 10. Hey, I can take care of the 10 because I'm kind of handy, but it's going to cost me money to get them fixed. So I want $1,000 off of the home price, or given to me in closing so that I can go and do the repairs myself. There's all kinds of negotiation that goes on with that. Next, you're going to have the appraisal. Appraisals, you got to pay for it. They're $500 to $800 depending on the appraiser. Do you need it fast? Because if you need it fast, then you got to pay a rush fee. So it depends. Okay, most appraisers come back within 7 to 14 days, somewhere in that time frame, but typically about 10 to 12. But I've seen them as fast as like 6 or 7, and I've seen them take as long as like 14 days. While you're doing all of that, you need to go and shop homeowners insurance. Okay? Find out, if you have insurance with State Farm, Allstate, Progressive, Safeco, whatever, right? Talk to them first and see how much homeowners insurance is, because they tend to bundle the policies and save you some money. But go shop other places because you may get better coverage for less money. There's other things about actual cash value versus replacement cost. There's just a whole bunch of stuff with insurance. So you got to make sure that what you're getting quoted is commensurate with what everybody else is quoting you, because if they're giving you actual cash value versus replacement, the actual cash value policy is going to be lower than the replacement cost. If they're giving you a 2% deductible for a roof versus a 1% deductible, the 2% is going to cost you more money if something happens, but it's going to lower your insurance payment. I know I'm talking Greek to a lot of you. That's why you got to talk to an insurance agent. Write these notes down: actual cash value versus replacement cost, deductibles, things like that. And then lastly, once you get all of that done, you're going to go to the title company and close. You're going to sign all your paperwork. They're going to take pictures, they're going to scan your IDs. You're going to have to wire or bring in a cashier's check depending on the amount, what you have to bring to closing, right? If you have to put a $30,000 down payment, they're not going to let you bring in $30,000 in $1 bills. You're going to have to wire the money, right? If it's like $500-600, they may let you bring in a personal check, a cashier's check, but never cash. They'll never let you bring in cash. You sign the paperwork, and then so you're going to go, and it's a 2-part step at closing. You got the closing part, which when you sign all the paperwork, that's the closing part. Then you have the funding part. So when the title company takes the paperwork and sends it to the lender's going to check all the I's are dotted, all the T's are crossed, make sure everything's good to go. Then they're going to release the funds. Once the funds have been released and distributed as necessary, that's the funding part. And at that point, the house becomes yours. Pretty arduous. There's a lot of stuff going on. That's 18 things. There's a lot more things that go on in the background, but that's why you get a good real estate agent such as myself to help you go through and guide you through the ways and try and make it seem as easy as possible. A good lender, a good inspector, and a good title company and a good real estate agent will make the transaction that much smoother. So if you have any questions about anything, you're looking to buy a house, you're looking to sell a house, make sure you reach out to me. I'll give you whatever thoughts I can on it. If you're in the San Antonio area, up through New Braunfels, that's my zone right there. But I appreciate you watching. Make sure you hit that like and subscribe button so that you can get all the great tips that come out on a frequent basis.